all stages of our clients' investments. Our team has decades of experience in all types of markets, guiding clients through some of the most challenging times for investors. Our all-hands-on-deck approach generates more offers on your listing, and according to CoStar, we have sold our listings faster and with the highest list-to-close percentages over the past 2 years. For buyers, we identify and negotiate the best terms possible, ensuring your long-term success. We hope your time with us today helps your passive investments become massive investments. Centennial Advisers, here for you now and always.
Good afternoon, everyone. Welcome to our Centennial Advisers webinar. My name is Justin White. I'm managing partner today. I'm joined by Jason Brooks of Buchalter. We thought we'd spend some time talking about some of the leading issues in the commercial real estate market. What we're going to do today is we're going to look at some of these headlines. And what we're really going to do is talk about where do we think that particular headline or issue is headed. We'll keep track of this information, and then maybe in 6 or 12 months, we'll do a little recap, see how well we did. For anybody who wants to join in and ask us about a particular topic or get our prediction of what we think where that might lead us, we will cover those. And you can use the chat, you can use the poll and the questions, and we'll get right into it today. I think we've got 10 or 11 topics, and then we might go off on a couple other things. But first, Jason, how are you doing? How's business? What are you seeing in your crystal ball?
I'm doing well. Thanks for asking. Things are good. I believe the market's starting to heat up. We have more deals that are, seemingly going into escrow. Parties are getting a little more creative, which I'm sure we'll talk about today, but things are moving in the right direction. And I think people are realizing that the situation that we are currently in is going to be probably similar for a while. I don't think we're going to be seeing 3 or maybe 4% interest rates for any time soon. So I think people are finding ways to, put their capital to work and get into the market, and sellers are starting to, become, more understanding of where the market sits now.
And we'll talk about where the market sits and how people are coming together in a second. But the first one that I think we'll talk about is distressed real estate. We've got a slide here that'll kind of talk about a little bit about what we're seeing as it relates to those numbers. But distress gets talked about a lot. I think we both have a mutual friend that thinks that we're going to see a lot of distress and those numbers are going to go up robustly. It's interesting. To me, I feel like they're equal parts people hoping for a RTC-like mass sell-off of foreclosed properties. And there's maybe equal parts hope that distress kind of subsides and the market recovers fairly quickly. I know you work with a lot of lenders across a lot of different product types. Maybe talk about what you're seeing there on your end and kind of what your thoughts are on the direction that we're headed.
Sure. So, there is a lot of debt that is becoming distressed. It appears mostly to be in certain specific product types, office obviously being hit the hardest. Where I think that we may potentially see other distress coming, which hasn't arrived yet, would be, properties that have been in development that are still on construction loans. I know of a few deals personally where the construction loan interest rate is lower than what the refinanceable interest rate would be right now. And I don't think anybody forecasts that in their pro forma underwriting of the deals when they build it. So there's going to be some situations where how do you refinance the construction loan out? Those situations are going to start popping up. And I also think that, there's $1.4 trillion of commercial real estate debt coming due between now and the end of 2024, I believe it is, might be 2025. But regardless, the rates are going to be, if they stay the same, probably 40 to 50% higher than what they were when that debt was placed. And so that's going to create more of the problem. We're just right now at the very beginning of it.
So let's talk a little bit more about being at the beginning of the problem. It sounds like you expect to see some increased distress. I tend to agree with you that I think it's going to be fairly product specific. But what do you think the process is going to be? That was the biggest thing when I look back at the RTC days of the 90s and heard those stories compared to what we saw in the early 2010s. Very different environment, and how institutions and investors that acquired debt or acquired just handled the distressed debt scenario. What do you think is going to be the way that it plays out this time? What's that process going to be?
So let's start with banks, right? Banks aren't in the business of owning real estate. They prefer not to take it back. So I think you'll see a lot of banks try to offload their debt. The issue that we're running into right now is on the deals that are hitting the market is the value of the loan, like the principal basis of the loan, is more than what the property is being appraised for. And so if that's the case, banks are going to have to sell the loans at a discount and being willing to absorb the loss. And then they're going to and recognize the loss. And then because they have to leave enough room, for the buyer of the loan to make money. So I think it's going to be people that have a lot of cash available to buy the debt. And if they can get the right discount, because they need to, and have a business plan, right? So Justin, if you owned large office buildings right now, what are you going to do with it if you can't fill them up? Are you going to convert it to multifamily housing? Or are you going to try to make it a hotel? What does the market need? Obviously, housing's the easiest answer, but does that work?
And we'll talk about that in a minute. To answer your question, what am I going to do? I'm going to do exactly what the institutions are doing. Walking away from selling at a steep discount properties in the portfolio, all the while raising another fund to buy things at steep discounts.
Right. But okay, you buy the property at a steep discount, then what, right? My thought is if you buy something at a low enough of a basis, right, you can figure out what to do with it, right? Even if you rent out, there's still a need for office, right? So maybe you just decide to rent out at 25 or 30% below market. But if your basis is low enough, you're going to make a great return. So there's ways to keep it in its current use if you can get it at the right price.
Yeah, and my personal opinion is I think we're going to see a fair amount of that. Whether it's, I think the trend is moving back towards companies see value of being in the office and having their people together. And we'll talk about in a minute the affordability of converting, of how we get more housing, whether that's office or motels or whatever it may be. But the distress thing, I think, as Jason said, we're going to see it in certain circumstances and in certain segments of the market. The one thing that I think we've seen lenders learn from previous times is that they were more resilient in keeping their safeguards into the debt that they were offering, whether it was still a debt coverage ratio. I think the lowest I maybe saw was 1.15, but somewhere in that kind of 1.2 to 1.4 range, we saw a lot of debt there. And then in some conservative underwriting of expenses, all building in at least a little bit of a buffer for the investor before things get troubled on the property specific basis.
Well, and Justin, the other thing is too, right, is part of me right now is less concerned about payment default as it is maturity default. And what I mean by that is you have enough tenants, you have enough cash flow where you're continuing to service your property, right? But when it comes time that your loan is maturing, which was that large $1 trillion number I threw out over the next, I think it's 18 or 30 months, that you can't refinance because the refinance that you need to do would require you to put in a ton of cash because you can't get the loan to value that you need. Or if you can get the loan to value that you need, you're not making enough rent to get to the debt service coverage ratio that you mentioned that's required, right? So then are you going to take a mezzanine equity piece in that's going to bridge the gap? I think that's where I think a lot of the concern is going to come in given the current market today.
So let's talk about that for a second. The different types of default. Are there different remedies? And are there, I guess, a different likelihood of the remedy chosen in a maturity default versus just a payment default?
So a payment default, you foreclose, but you can cure the payment default, right? You can cure the payment default by making the payments, right? And you have a time period to cure and different steps you can take. I'm just California, for example. On a maturity default, you're in default because you're in breach of the loan term, right? And the only way to cure that is to pay the loan off in whole, right? It's not that you can just get the payments current, right? Because you could go into maturity default and you could pay a maturity default interest rate, which could be 30% more. But just because you can service that payment doesn't mean that the bank doesn't have the loan in default. So I think, one of the options you might start seeing is, parties negotiating, hey, I can't refinance you out at X, but you still are covered. There's plenty of equity in the building. The building's still performing. The old loan was at 3.5%. The market's at 6.5%. Can you make me a loan at 5.25%? That's what works for us. It avoids you having to sell the loan or take a loss, and they can kick the can down the road a few years. So that might be an option that you see between a lot of lenders and borrowers is, okay, we're going to not refinance, but we're going to modify the loan, issue a few year extension, up the rate, right, and make it work so that until people can get into a place where either, the NOI justifies a loan value or rates come down where they can refinance out.
Great. I'm glad you shared that, because I think that understanding those different options, understanding what that looks like, is certainly really helpful to people. So in addition to distressed, we'll talk about the next one, which is certainly a big California issue, which would be affordable housing, and how affordable housing and low income housing gets affordable. It seems like, and this is certainly California specific, but very challenging. I saw a thing the other day that an affordable housing project was going to cost $750,000 a door, which, I guess that cost only gets passed on to taxpayers. As you work with affordable housing developers that are working with cities and counties, et cetera, where do you see we can make that more affordable? And obviously, if there's more, if they make it more affordable, there's more money to provide more housing, which is win-win for the consumer that's, can't afford to get into a place, whatever it may be, solving the housing crisis. Where do you see the inefficiencies in this, Jason?
Well, the price per foot's really expensive. If you were to build ground up, you should be able to build ground up even in LA on like an apartment building for far less than $725 a square foot, all in cost. The price is substantial. I mean, I have clients, as that build high end spec houses too. And like on a house that you're selling for $2,000 a foot, $1,700 a foot, your all in build cost is $725 a foot. And we're not building $20 million, $30 million houses. We're building affordable housing. So I think right now, the big issue is how do you create a cost-effective way to build affordable housing? Historically, government subsidized housing was done either through Section 8 or Section 42, right? Where there's government subsidized tax credits in Section 42, and then Section 8, there's other, rent benefits where the government's paying the delta between what the, renter can pay and what market is. I think those programs tend to yield you the best result. But it's also finding ways to find underutilized properties and turning them into, you buy them at well below replacement costs and you can efficiently turn them into affordable housing. Because Justin, one of the issues with converting office to regular apartments is the floor plates of an office building are not plumbed for multifamily. They're not structured and set up and shaped for multifamily. So it ends up being not always the most efficient use of the space. You end up with some inefficiencies or weird shaped units, stuff like that. But I think if you're going for more affordable housing, and you're not looking for a market rate tenant, those things are more acceptable than they would be to a market rate tenant.
You mentioned something interesting when you were talking about Section 8 and Section 42, and like thinking about the housing and the product. All of that product built at really kind of the exact same cost as the product down the street or around the corner. Those projects built by, in most cases in California, private developer utilizing, getting the benefits of the tax credits, where today I think we're starting to see a lot more of that affordable housing and the product be subsidized or really more quasi-government owned or funded projects versus what we saw in the some of the previous affordable housing development.
I think that the government, no offense to the government, and certain things are not as efficient with money. To put it into perspective, when the average Section 8 apartment rent leaves Washington, D.C., it's about $3,000 a door. By the time it gets to the tenant, it's about $1,800 a door, because there's fees at the state levels and the county levels and the city levels, and whoever's administering those, the fees take out some of that available rent money. So I think putting it in the hands of private developers is great. And even if, Justin, if you put it in the hands of private developers where you said, the government's going to subsidize some of the rent, like a Section 8 tenant, and you're going to get, property tax reduction, and, you're going to agree to certain things with the government for a certain period of time, and those subsidies will run. And then, at some point, those subsidies run out. And at that time too, you can go to market rate. There's opportunities for people to do that, right? And I think there's even potentially going to be buildings that are government-owned buildings that they don't need anymore, that they could turn over, like do a private-public partnership, right? But I think ultimately when you work with private markets, they have and private companies, that they have a push to be as economical as possible based on their fiduciary duty to their investors, shareholders, and owners, versus, the government isn't always the most efficient with the spending of their capital.
Well, and great points there. And, we talk about the inefficiency of the government spending capital to develop housing in areas that need it. Probably takes us perfectly into our next topic, which is opportunity zones, place where you and I have spent a good bit of time in the last year or last couple of years. But opportunity zones, kind of the private side to go in, and whether it's take a building and put a significant amount of money into it, or build from the ground up. There's plenty of incentive for private development to add to the quality of the housing stock or develop industrial, retail, whatever it may be. I think our take and our perspective on it has been here at Centennial that opportunity zones was the one thing that everybody could agree on in the Trump presidency. It certainly seems like it is still the one thing that both sides of the aisle agree on. Investment benefits for people that put cash into these areas, positive neighborhood and community benefits for new housing and new jobs. If anything, the one thing that might, prevent it from getting extended is just the idea or the push that, it's wealthy people getting a tax cut. But talk a little bit about what you're seeing in the opportunity zones. There's still legislation to extend it for 2 more years from Tim Scott and Cory Booker, which would push all the provisions and benefits out and give investors kind of continued excitement to do it. I think what's interesting is that this was December 2017 when this gets passed. I think each year we've seen increasing investment in opportunity zones, which lends itself that although some of the financial benefits are expiring, or you don't get as much benefit of them as you did, as people learn more and more about it, it's a win-win sort of program and opportunity.
Yeah, absolutely. I think the opportunity zones are probably the best thing that's happened to real estate in a very long time. And I think that there's a lot of opportunity still there. I think, people that want to build multifamily in those opportunity zones will really benefit as well. But I think all properties work well. I mean, Justin, we're as big a proponents as anybody of it. we do probably as much as anybody on an individual deal by deal basis. I'm sure there's people that do much larger deals than we do, but I would say from a volume perspective, we're doing a lot of these, and I think we're really passionate about them, enjoy them, and the benefits for the clients. And as a side note, Cory Booker in Congress one time when I was working in legislative stuff said the best line I've ever heard a Congress or a senator say. He said, I got to go to, it was a NCAA hearing, and he said, I got to go to Stanford because I had a 4.0 and 1600. Everybody thought he was referencing his GPA and his SAT score. And he said, no, it was because I averaged 4 yards a carry and had 1,600 rushing yards my senior year. And it was a great line. So just when I saw him and Tim Scott sponsoring the bill, I think that points out to you that legislation that's co-sponsored by a Democrat from New Jersey and a Republican from South Carolina shows you couldn't get two more diverse, backgrounded individuals in politics, and how important that this legislation is. There's one thing I do disagree with what they're proposing is sunsetting certain areas where the, median income is over 130% of the national median income. And, while I understand the point of this, it's supposed to help areas in all states. And when you have a state like California, for example, or a state like New York, where the median income in those areas is just higher than other places, that doesn't mean that the average income in California is much higher than the average income in Arkansas, right? And just because of cost of living and a bunch of other things. And I think that there's still areas of California and other places that need those opportunity zones. So I'm hoping that they keep those, alive and going. So I think that I wouldn't be opposed to them adding more locations and more opportunities to stimulate more development. But with our increased population, we just need increased housing. So maybe they give additional incentives to people that want to build multifamily versus just, industrial or office or any other type of product.
Let's stay on opportunity zones for a second, because I think a good portion of the work we've done has come from, I would say, non-traditional real estate investors, and whether it's been through relationships that you have and attorneys in your firm who work closely with a business owner, or somebody who's had a capital event outside of commercial real estate. And the way that we've structured some of these captive opportunity zone funds into very passive investments is really appealing. Talk for a second, just kind of who has been the right person that we've worked with outside of real estate that has been able to take advantage of these opportunity zones.
Sure. I think the right person is someone that has what I would call a liquidity event in their business. So oftentimes that's someone that, sells their business to another company and gets a large amount of capital and is looking for ways to optimize their tax structuring with that capital, but also at the same time is looking for, they maybe have invested in the stock market in the past. Maybe they own the building that their company was in, but they're not looking to own or operate an apartment building or a hotel. They just want, they want their money to be working. They don't need to have the largest return. They're not trying to hit home runs, singles and doubles with the basis that they're starting with from selling the business is plenty enough to give them a great life. And those seem to be the people that we really like working with, and they like the long-term benefits, especially too, when you have situations where, people might be a little older and they've sold their business and they're retiring and they just want the cash flow. But the benefit of the opportunity zone is it passes through to your estate. God forbid, should something happen and, you pass away, the OZ benefits pass through to, the people inheriting the property. So there's a nice other benefit there as well.
You talked about optimized tax structure a minute ago. Maybe the short version of where and how people can experience some tax benefits by utilizing opportunity zones.
Sure. So the first one is when you realize your capital event. So you get your money, right? You sell your business. By the way, you could also have IPO'd a company that you work for and sold a bunch of stock. You could have bought Apple 30 years ago and decided now's the time to sell it, right? I mean, you could have bought a piece of art or, at a garage sale and found out it was a Monet and sold it for a lot of money. Any of those capital gain events will work. So on that actual initial gain, you get to defer paying your federal income tax payment until 2027, April 15th of 2027. If you are in California, it's due the next year normally. If you're in another state, it's most likely also April 15th of 2027. We can talk with you about that on a case-by-case basis. There are some ways that we may be able to generate some depreciation from the real estate that will offset your current California payment now. And then the last benefit is any appreciation on the property. Any amount that the property goes up in value is tax-free to you. And if somehow you do depreciate, like if we do create some depreciation for you, the depreciation recapture wouldn't come into play because there's no gain, no tax paid on any gain, right? So just because you reduce the basis. Okay.
Thanks for kind of highlighting those. It really is, from a tax standpoint, there's some amazing benefits, and structured correctly can have near-term and long-term benefits as it relates to somebody's taxes, in addition to controlling a good quality piece of real estate with a great tenant. You mentioned California and how the situation may not be as rosy or wonderful in California as it relates to them or the state getting their tax payment earlier. I think that there's a number of people and businesses. I've got friends that have moved to Tennessee, but specifically our next slide is going to talk about business exodus from California and how that is continuing. I guess my question, or, when we talk about predicting or crystal balling the real estate market, is, do we think that this is a long-term trend, or is this a short-term thing that's going to correct itself at some point, the number of businesses that are leaving California?
I don't think so. I think you'll probably see more leave, and I think you'll see less stay because the legislation that continues to get passed in California is not only making it harder for companies to operate and be successful in California, but it's also, remember, these companies are successful because of their employees. And I think a lot of the employees are starting to get fed up with, all of, sadly, the day-to-day items that are having to be dealt with in California, whether it's, homelessness or crime or, just education concerns for their children in certain situations. And so I think you're going to continue to see people leave. I don't think you and I have met anybody that has left California that says, I want to come back. I think more of the people say, I just now wish I would have done it sooner. And by the way, I'm California born and raised. Like, I think that there are so many great things about the state, but I think until, there's a change made in how certain decisions are made from a government perspective, both at a state level and at a local level, it's going to continue to spiral. So,
my opinion on it is companies probably don't leave, or probably don't stop leaving. But I think that there's going to continue, and there will always be the formation of so many leading companies in California. I was having a conversation with somebody the other day, and we were half joking about our friends that have left, and just still a willingness to pay the weather tax in order to be here, and how wonderful it is. And I think that California will kind of always have that draw, and companies will get created, and there's a lot of intelligent workforce here. And visionary people that will build and create. But as you build and create a company and you start to be successful and you start to make good money from a being fiscally responsible standpoint, it's harder. It's hard to stay. And, maybe even so to the point that where, California, if you can be successful in California, you probably can be successful anywhere, because there are so many headwinds and challenges and costs associated with doing business in California. But I think over time, like I said, the fiscal responsibility of their own personal net worth and of the company is leading people to leave. And that's probably not going to change until we get a climate that is more supportive of business and seeking to grow the success of all Californians through the success of the businesses that are here.
Well, and remember something too, Justin, right? Like at the end of the day, companies have the executives at companies, the employees have a fiduciary duty to their shareholders to do what's in the best interest of the company. And if there's a 10 or 15 or 20% increase in costs for operating within California, or you move outside of California, and think about from an employee perspective, right? Like if you get paid the same in California as you do in, let's say, Texas, right? You're paying no state income tax and your dollar goes further. So it's like getting a double raise just for moving. Your employees should be happier. Your costs are going to go down if there's just an operating cost associated with being in California. So your shareholders are happy. It boosts the value of your company. Then from the executive perspective, their options are worth more. They get bigger bonuses. Their comp goes up. Like everybody seemingly benefits to that. And your point, right? There is, you call it the weather tax or, some other stuff, but there's going to be a point in time where for everybody, or for at least a lot of people, it's not about just the tax anymore, but the tax and the other things make it where, you could go live for 8 months and keep your house in California and come back for 4 months and enjoy the best 4 months in California, and then go back and have all the savings. So.
Well, we'll move on from companies leaving California and move into our next topic and kind of the numbers. Commercial real estate activity in Q2 down 50% year over year. Jason, you had mentioned earlier when we were talking about distress that you felt like we were maybe in a period where there was some certainty, or at least there was a bandwidth of where rates were probably going to stay. Maybe the biggest difference between the next 12 months and the previous 12 months has just been the volume of interest rate increase. And if we get some stability, where do you think we're headed here? Usually the fourth quarter is our busiest quarter, most productive in the commercial real estate business, the highest volume of transactions. Do you think we're going to see that pick up as the year, nears its finish?
I think so. I also think so because the start of the year was so slow. There's not a lot of places to go but up. I know that you guys at Centennial have been really busy, right? And are still possibly on pace for your biggest year ever, which is, I think, more of a statement than anything about, how great you guys are as a company and what you guys have built and how you work with clients. But I mean, if you look at I believe it was JLL had a statement that they issued that, their volume and their revenue was down 99% or something like that recently. Some of the other big brokerages, Cushman, I think it was in a similar situation, in the 90% decrease. And so I think from that perspective, the only place to really go is up. I also think that they're saying maybe at most one more 25 basis point increase this year. But I think to your question, over the next 12 months, I think you're going to see a lot more volume, mostly because Jerome Powell is a member of the president's cabinet. So he works at the pleasure of the president. Next year is a presidential election. It's a big election year for both the House, the Senate, and obviously the White House. And so I think, as you start getting closer to the election, you will see pressure to lower rates. I don't think you're going to see them go as low as they have been the last few years, but, even a 1% or 150 basis point drop would be huge for the market. And so I think you're going to start seeing stuff like that. And also, just as a historical point, rates have gone down in every presidential election year since 1900. So something to keep in mind. I think that has to do because the person that controls the rates ultimately works at the pleasure of the president. So just keep that in mind.
It's interesting with volume being down. I think that most people in our business, it's such a negative, and obviously we like to do deals. They're fun, and that's how we make our money. But I think that the the silver lining in the cloud of less transaction volume and higher interest rates is really the opportunity in 1031 exchanges. Most people often think it's now not the time to do it, but when velocity is way down and we have seen cap rates go up the way they have, I mean, you had mentioned that we're having a good year, and we certainly are. And part of that big reason is that how much cap rates have moved on the more passive investments. On the net lease stuff, you're still getting a high quality tenant, great location, but those cap rates have moved so much in lockstep with interest rates that a lot of our clients who maybe couldn't double or triple their cash flow a year or 2 years ago are now able to do so because where cap rates have moved, because cap rates on what they're going to buy have moved so much higher than the cap rates have moved on what they've got to sell. The other thing that I think on the exchange side that people don't necessarily consider is there's so much less competition in the marketplace today. And in the private client space, whether it's up to 100,000 square foot industrial building or a shopping center, or, let's call it up to a 50 or 100 unit building, there are still people that are going to sell a property because of forces that are not related to the economy. And those buildings are always out there. And now if you're in an exchange and you sold your building, you're not competing with as many people, and you're not competing with the syndicators that really, and speculators that have driven the market up a couple years ago. So there's a lot less competition. There's still a lot of good product on the market. And because cap rates have moved a little bit, you're getting those properties relative at a discount compared to their high price. And if somebody's in the real estate market today and owns real estate, they're in real estate because they think the stuff's going to be worth more tomorrow and 10 years down the road. And if you think things are going to be worth more 10 years down the road, it kind of makes sense to have a bigger chunk of it than a smaller chunk of it. So I really think that the silver lining of activity being down and prices dropping a bit is the golden opportunity to do an exchange where you're maybe selling high and buying lower versus what happens, from 2011 through 2022, where people they were selling and then they were buying higher.
Well, and Justin, to that point too, right? It works. Now is a great time for people that have owned properties for a really long time and have just seen a large amount of appreciation. Where sure, if your building was worth $10 million 18 months ago and it's now only worth $9.25 million, but you bought it for $2 million, right? But to your point, you can lock in that, $7+ million appreciation increase. And now you're getting so much more on the buy side that it just makes sense, right? The amount that you've lost on the sell side is more than made up for by the increase you're getting on the buy side.
And you're really kind of the last point to that is that, we've sat down with so many investors this year and we've looked at their current cash flow. And they may not have a lot of debt, but they may want to use a little bit of debt to get some more depreciation in their exchange scenario. And so often we're showing them that they can make as much or more cash flow in a better building today at today's rates. And just think, at some point, rates are going to go back down. And when rates go back down and they refi at 5 or 4, or maybe we get back to the days of something in the 3s, how much more additional cash flow that's going to make them compared to the building that might be free and clear today, or very close to free and clear.
Right. I think now's a good time if you've got an asset that you're kind of been wanting to offload, or you wanted to do some repositioning of the portfolio, especially to your point in the private client space, because those are properties that buyers might be buying all cash, or people are looking to do value add or whatever it is. Those buyers are still in the market, right? And they're either using private debt, which hasn't really changed, or they're not using debt at all. So I think it's a good opportunity.
Yeah, I think it's a really good opportunity. Maybe we'll talk a little bit on this next one about what people are trading into and what might be some good exchange options for them. We've done a lot of business together in the last few years with 7-Elevens and opportunity zones and 7-Elevens just as part of a 1031 exchange, and thought that we'd spend a minute just talking about the C-store space, what we think of it, where we think it's headed. We've seen cap rates on a 7-Eleven go from the low 4s to the mid 5s right now. And just kind of the C-store space, what we think about it. I will tell you, when we found this article, I loved it because I have gone from I always stopped at a Chevron gas station guy to all the drives we make in the summer across the Western United States that I only stop at a Maverick. And I'll go 10 more miles to be able to stop at a Maverick. And so why do I stop at a Maverick? I stop at a Maverick because it is cleaner and the people are nicer than if I would just stop at your typical fast food restaurant, maybe aside from a Chick-fil-A. And so my experience is better. It's cleaner. And I got a need to stop at this place because I need some gas, that if we want to get some food, we can. And whether that's hot food, cold food, for real, whatever it may be. I am a huge Maverick fan right now, and think a couple of these other brands that I've seen as we've gone across the U.S. looking at property are also some pretty exciting ones, in addition to the 7-Eleven, the Circle K, kind of the staples in the marketplace. You got any comments on C stores and maybe how they look and how they compare to QSRs in your opinion these days?
Yeah, so I'll say having helped clients buy a bunch of these new 7-Elevens, the new 7-Elevens include usually 1 to 2 restaurant concepts in them. So I think that they're kind of changing in a very positive way where it's not just the store. But having spent a lot of time in the South, Buc-ee's is all the rage. They have over 100 gas station pumps at most of them. And then you walk in and it looks like not like Costco, but it's huge. It's like a giant building, tons of different kinds of food options. You can buy clothing, you can buy camping supplies. Like it's almost like Walmart with food. It's pretty crazy. It's a really interesting concept, but the excitement around them and the fact that like you'll walk around the South and people are wearing like Buc-ee's t-shirts. You don't see people wearing 7-Eleven t-shirts. I don't know about Maverick because I haven't been blessed enough to have visited a Maverick, although now I'm feeling inspired. But they're like, you'll just be walking down the street or in the airport and people have Buc-ee's t-shirts on. And I'm like, that's how you know that you've done something right. So,
it's like I look at them, and when we talk about people doing an exchange to make things easier, like we're big QSR fans at Centennial, and we have been for a long time. We've been big fans for a long time because they usually have the good out parcel location. And the trend is that people are eating out more and convenience and all that sort of stuff. But when you look at these C stores, you would really kind of argue the location is probably better than the typical fast food because it's usually right on the corner. 2, it has the same convenient food aspect, but that people need gas makes them have to stop there. So from a convenient standpoint, when it comes to food, as now more and more of these places have restaurant concepts in them, I really like the C store as a easy exchange option, almost equally to QSRs. And we're starting to see the cap rates on these be even a little bit better, and they might have some more benefits.
Well, the benefit you're hinting at is if you have a depreciable basis, the ones with gas stations involved are eligible for bonus depreciation, which means you can accelerate all the depreciation available into the first year, which, well, not all. Now we're at 80% of the depreciable basis this year. Next year would be 60% of the depreciable basis all in the first year.
Question for some people that might be watching us. What if I don't use all my what if I don't need all that depreciation? Do I lose it?
No, you can carry it forward as a carry forward loss to future years to offset income in the future years. You can also use it in future years to offset cash flow from the property. But in situations where you might have had a big capital event like selling a business, it can offset the taxes from the sale of the business.
Really, some good opportunities, like Jason and I said, in addition to the 7-Eleven and Circle K, which are the big players, all these really kind of regional brands Wawa in the Mid-Atlantic, Buc-ee's in the South. I want to say Sheetz is Texas in the Southeast, and then Maverick kind of in the Intermountain West. Those regional brands that maybe one of them ends up conglomerating them all at some point. But really some interesting options when you factor in the quality of the product, the income stream, and then, as Jason mentioned, some of the tax benefits that you can get that you can't get with some of the other net leased options available, make them really intriguing. We'll kind of circle back now because I think Jason and I could talk about C-stores and opportunity zones, and the combination of C-stores and opportunity zones for hours. We'll be back on the debt. Jason mentioned this earlier, and we're going to talk a little bit more about it now, is kind of this concern, I think, that people in the industry have, that maybe not a lot of the private clients loan, people with loans are really considering, that got the 3, 5, 7-year fixed rate loan, is what that's going to look like when these things mature. Jason had said that his big thing wasn't a payment default, but more of a maturity default. That can also mean when a loan might go from fixed to variable, or might go from interest only to principal and interest at a new rate. But Jason, why don't you talk a little bit about this? I know you and I both talked to Michael Dirk a lot with Marcus & Millichap Capital Corp, who this has been his, he's been sounding this alarm for investors for months now about, do people really know what their debt looks like when the fixed period burns off, or when it goes to some sort of variable or principal and interest?
Yeah, I think that's part of the problem, Justin, is because many people went into 5-year fixed debt, 7-year fixed debt, right? Situations like that where it's now rolling off. And historically, you never thought about what happened after the fixed period ended, because you were just refi, right? Like there's no usually lockout on a refinance. There's no prepayment penalties at that point. There's no yield maintenance or anything like that. So you don't run into those problems historically. And oftentimes, if rates had moved 50 basis points or 75 basis points in that fixed period of time, you've had such a large increase in the value of the property and rents and everything else that it was not a problem, right? Like you could at minimum refi and take out the principal. Maybe you weren't cashing out. Maybe you were doing something, right? You were just straight refi. Now the rates will jump so much, and the current loans you can get are so much higher, and banks are cautious right now, right? Like the loan to value. I mean, Michael loves to talk too about how hard it is to get anything over 50% loan to value, right? Like it's possible, but hard. And it has to be, the world's best borrower and a bunch of other things, right? And so when you look at it from that perspective, we might have a situation that people can't refinance their loan. The loans are in maturity default. Now, to your point, from a maturity default, as if it just goes to a floater and they can't service the new higher rates, then there becomes a payment default, which is an additional default. So I think that's also part of where the issue runs. So
it's interesting, I think, because where these rates could be or where they are today is that we think about when a lot of people were getting these loans at 2.95, 3.25, 3.5 fixed for 3 or 5 or 7 years, whatever it may be. The rate at the time, both the 10-year and the LIBOR, was all sub 1%. So banks trying to give themselves some room and some ability to make some money, we're putting spreads of 250, 300, 350 on those indexes. And a lot of the loans, especially for multifamily in Southern California, are now tied to the SOFR rate. That's 5.31 today. When we sit with people and we bust out our financial calculators and we show them what that payment looks like on their $2 million balance compared to what their payment is now, it's some shocking stuff and is going to suck a lot of cash flow out of owners' pockets. And that's probably the good news, is that it only takes a lot out of an owner's pocket. It doesn't get called by the lender because of their requirements and their rules that, there's got to be a certain amount of liquidity. There's got to be a certain amount of debt coverage ratio and all those things in the operation of the building.
What it also might cause, Justin, is people that feel the need to sell their property and get whatever equity they can out of it versus losing it to foreclosure if they can't refi, right? So, maybe it was a 65% loan to value, and maybe even at today's numbers, it's a 60% loan to value, but, they can only get 45 or 50% and they can't come up with a 10% delta. Maybe instead I sell the building at 90% of, what it is. So I save at least that 30% of equity. Maybe I lose 10% of equity, but again, it's better than losing the whole thing to foreclosure. So,
and you know what, Jason, absolutely. I'll give a personal experience on a little property I've got that, let's see, the loan to value right now is probably right around 50%. Loan was originated 2 years ago. It's great. Property cash flows, all that. If I were to have to refi today, I could barely get the same loan amount, and my cash flow would get cut down, would be cut by 2/3 at today's rate.
Wow.
And the property's doing great. It's got good tenants. It's in good shape. It's a fine little property. But just how much that rate would change, it's significant in not only the loan dollars available, but also in what that payment looks like at similar loan dollars.
I also think it makes you start to wonder that, well, when you have such a good low rate loan, you never want to lose it, right? So but at the same time, are you better off if you don't need the excess cash flow trying to pay down the principal faster, so that in case we are in the situation we're at today and the time comes and you have to refi, that you don't just get crushed, right? Do you take not all of it, but some of it, and just so when you refi, yes, you know that your building is going to be under levered. Yes, you realize that, you have such a great loan and you're giving up some of it by prepaying parts of it early, but are you setting yourself up for more success and safety in the future, right? In case the situation hasn't changed drastically. I don't know.
No, it's, I think that these things, as it relates to financing and the capital markets right now, and where things are at and what people can do, they're the issues that, as an investor, there's obviously great times and good years and you crush it and you kill it. And then there's other times where things change and you got to be, a problem solver, and you got to figure things out, and you got to adjust to whatever the landscape is. And right now on the debt side of the equation, it's a different landscape. The next slide that we're going to go to is some of the bills that didn't pass in California in the last year. But really, when we look at them and take a look at them, that's a different landscape too. The landscape from where we were 20, 15, even 5 years ago, significantly different. I look at this list and I go, I can't see any of those things ever passing, number one. But not even that they passed, just that they were proposed and discussed, and that's the environment we're in. The right of the first right to purchase, that the tenant or a qualified organization could buy the property versus it going on the open market and letting you take the best offer and bidder or whoever you wanted to buy your property, is just that it's on there. Gives me an indication of maybe what might be coming or where we're headed. And it might not get to that, but that one seems like a really tough pill to swallow. I think the cost that goes along with the second one from the bottom, SB 460, that you couldn't do criminal background check. And where do I say cost? I think the cost really comes from that if you weren't able to do that and you got a tenant in your property that maybe made it where other people wanted to leave, the cost in all those remodels, the cost in lost rent, the cost in the vacancy, all of those things, and how it can have a negative impact on an owner from being able just to decide, who do I put in my building, and having the control to do that. When I look at this list of some of these bills, it just certainly seems like that the landscape of owning property is changing, and how owners respond, react, and operate their buildings is going to have to change too. What's your favorite one on here?
So when we talked about 919 last year, I just thought it was an opportunity for people, because like the tenant or organization gets 90 days to notify you if they want to, and then it was some crazy number, like a year to buy the property, to put the capital together, whatever. So I just said it's just going to be an opportunity for them to say, you need to pay me a fee so that I don't drag this thing out for 15 months, right? Because there was no penalty to them if they didn't close at the end of the year, right? And what happens if there's market changes, and then what happens if one organization says yes, and then 15 months later another organization says that they want to do it, right? Like that was the one I think that scared me as much as any. Given what we do for clients, I would hate the statewide database of termination notices and rent increases. That would be the one that scared me, especially when it came back that we represented all these different people that were doing, no fault, just cause evictions because they needed to remodel units, and people don't realize that it's doing good to the rental pool, right? Like you're spending money to make the units nicer so people have a better place to live, but it would be spun as you're throwing people out that have below market rents just to get higher rents. And it just depends on what perspective you look at it from.
Yeah. And, I think our perspective is really so unique on this stuff because we work with so many owners, and I'm going to say most, but it's not even most. It's like almost all owners want to have really good tenants, want to have their property be in good repair so it doesn't cost them money, and want to have a productive, positive partnership with their tenant, whether that's a commercial property or a multifamily property. And we see that's really the intention of so many people. But unfortunately, a lot of the legislation and the laws are designed to address the very small point of the population that, on both sides, on the owner side, address the small percentage of the population that isn't trying to have a positive, productive partnership with their tenant. And in doing that, the legislation also overly protects the people that really are bad apples, and hurt the rest of the good tenants out in an apartment building or in a commercial space or whatever it may be. I think when I always see some of this legislation, I think, is there a better way to accomplish the goal that benefits more people? Because a lot of this stuff does not benefit most of the owners or most of the tenants.
Well, what it does, you're right, Justin, is it pins the owners against the tenants. Because in order to protect themselves, owners are required to do certain things that they don't necessarily want to do, because if they don't do them, then they're punished down the road, for being essentially too soft, too understanding, too caring.
In this, we're talking about, it hurting owners and tenants. One of the places that it probably hurts owners, or we know it hurts owners, is that it's not the same job that it used to be. Right. It's now a much more complicated job. And the question on our next slide is really, on a go forward basis, do we think owners need to have a professional property manager for their building, whether it's commercial or multifamily? Is the only way to deal with all the laws and all the things that you have to do to protect yourself, have somebody who does it full time?
Personally, I think so. I think that a good property management company will save you more than whatever their fee is, whether that's in the value of your time, headache, cost, to implementing professional strategies that get you better rents, that are, costing you less money on repairs, whatever it is. I think a well-run, productive property management company does exactly that. Like I think that their fee is offsets, the increased cost of their fee to you is offset by the savings that they create. So I would recommend it unless you own your own property management company or you've decided that your full-time job is managing your portfolio.
You say that, and the thing that came to mind for me right now is our firm is talking to a lot of owners about SB 721, which is the balcony law here in California. And if we kept track, I would say 70% of owners know nothing about it. 20% of owners have heard of it. And maybe 10% have already done something. And we've looked at some cost estimates and some studies on these things. And I mean, the cost of doing the work is going to be significant. But there's a deadline for that coming up on January 1st, 2025. So we're, 19 months away from the deadline. That if somebody hasn't completed an inspection, if they haven't done emergency work, if that's required, the penalties that can be imposed on an owner are in the 4 figures on a daily basis. And that's a piece of legislation, that just nobody's caught yet or been aware of. And so there's the penalty concern. But for us, when we look at so many of our clients that don't know about it, well, what's going to happen in the last 6 months of 2024? It's going to continue to get publicized. And finally, there's going to be enough awareness that everybody's going to try to get it done. And there's not enough inspectors. There's not enough qualified, good contractors to do the work. And so the cost is going to go up.
I think that's your bigger issue.
I'm going to have to pay somebody more to get to the front of their line.
Yeah, the cost of the work and finding the labor to do it. That's going to be the issue.
And so I think it's so many of these things, just the management has changed. It is, as you said, I think a professional job that if that's what you're going to do all day, you can probably still handle it. But if you want to enjoy retirement and go to the property every couple days or every couple weeks, it's a different ballgame these days.
I would agree.
The last slide that we're going to really is just kind of a comment, or I want to make an observation on, is California's population on the downward trend. We talked about businesses, and I'll let you look at the percentages there for a second about why people are thinking about it and the reasons. But I think the most interesting thing, and we'll show you the next slide here in about 30 seconds, was when California had started to have net migration out of state. In the 2017, 16s, 18s, 19, even into the COVID era, and in the early part of COVID, the argument that some people made was, well, it's okay because California is only losing the uneducated people that are moving to different areas. So it's okay if they leave. We're keeping the highly educated, high-paying jobs are staying in California. We'll flip to the next slide now and show you that now that is moved. And we're seeing, so the green line you've got there is net migration from bachelor's degree or higher. The blue line is less than a bachelor's degree. Jason, just as we kind of close this up today, make a couple thoughts or comments. It was easy. It was an easy thing to say, oh, well, we're not losing the good jobs, so it's okay. But you said earlier, you didn't think that this was going to change. Now that both of those groups are on the net migration out of state, thoughts or comments, or does the graph kind of speak for itself?
I think the graph speaks for itself. And I think it goes back to the slide we talked about earlier. When you look at the companies that are leaving, the companies that are leaving are taking the educated employees with them, right? You have educated people that work at Oracle and Tesla. You have educated people that work at all of those companies, right? But you're taking highly educated people with high income earning abilities and with high salaries out of the state, right? Ultimately, at the end of the day, when those large corporations leave with successful people, and if you look at it too, a lot of the people that are leaving are what were the upper middle class of California too, right? Before the taxes went crazy and cost of living went through the roof, you have a lot of the upper middle class moving out for just a better lifestyle for their family, right? The ultra wealthy, if you make 25 million bucks a year and you pay $12 million in taxes, like you still have $13 million, you can do a lot, right? But if you make 500 grand a year and you only get 250 versus you go somewhere else, you make 500 grand a year and you get 350, and that 350 goes further, it's really something to think about from family perspective, from lifestyle, from a lot of different angles.
And you know what? It's not just I've got to follow, I've got a good paying job. I had a degree. I've got a great job at a company. I got to follow the company. It's also the small business owner. It's the service provider. It's the independent contractor, and the highly paid ones, the very specialized training that now can do their job from anywhere because of Zoom, because of easier to travel, more flights, easy convenience, whatever it may be, that is allowing people to take their job on the road, so to speak.
And if you saw recently, there was an article published about the amount of theft in commercial retail and the cost to the commercial retail industry. It was $110 billion last year of commercial retail theft of value of product. And if you look at places like Target is closing 14 stores. Target never closes stores, right? Target puts in too much research. They're closing 14 stores, and I believe like 6 or 7 of them are in California, a lot of them in the Bay Area. There's a lot of retailers, there's a lot of places that don't feel like they can operate. And to your point, if they can't operate, then how can a small business operate? How can a successful small business operate? And well, many small businesses have portability, so it's easier for them to move, 8 or 10 employees than it is to move, hundreds or thousands. And so there's that perspective to your point, Justin, is that it's easier to run a business. It's more business friendly in other states. I mean, Walmart had closed in an area in Georgia, and it became like a food desert. And so they were getting begged to reopen some form of a store there, and they're opening it, and it's their first store with a police station in it. They're actually putting a police station in the Walmart to try to protect the store. So
I hadn't read that article yet or heard about that.
It's in Atlanta.
So, we've talked today about a lot of the things that we're seeing, the key headlines, the things people are talking about, and tried to take a forward look on whether we thought they'd continue or whether we'd see changes. Jason, as we wrap this one up, any last comments that you want to share with our listeners and guests about the marketplace, what you think they should be considering, or any bit of helpful advice?
Sure. I think that, there's a lot of doom and gloom being discussed right now. But I think that there is still a lot of opportunity. And I think that people need to pay attention to the fact that there is a lot of opportunity. That mostly comes from the fact that, especially in the people that listen to this call, the clients that we work with, it's a lot of private client. There's still deals happening, still people that have capital that they need to place. And so if you have been considering and you're, I missed the boat, I missed the market, I missed my opportunity. No, you didn't. For the most part, unless you bought something in the last 2 or 3 years, and maybe even if you did and really improved it, rehabbed it or whatever, there's a really good opportunity in this moment, in this time, to sell what you have and reposition into something that you've wanted already and just get a better return, right? You're going to get more for your buck. You're going to get more cash flow. So.
Well, Jason, I thank you for your participation today. Everybody who's joined us, if you have questions for Jason, we'll get his contact information up here on the screen in a second. For those of you that have a relationship with a Centennial advisor, please reach out to them if you want more information or you just want our best ideas for your current situation. I really think that's kind of our strength of what we do, is understand where somebody wants to go and what they've got going on, and help them put together the most profitable, expedited path to get there. If you don't have a connection with somebody at Centennial yet, you'll get my contact information, and I'd be happy to connect you with all the right people. Thank you very much for attending today. It's our pleasure to put this on, and we hope you have a great day. Thank you.